Welcome to paper ACCA P4. We are still in the chapter concerned with mergers and acquisitions, and we're talking about business valuations. Among the various models, methods used for valuation are a couple of cash flow based methods mentioned that are treated in P4. Last time we talked about the dividend valuation model, and now we want to spend a few minutes to explore the discounted cash flow model, discounting of free cash flows. And the key thing here is that we are looking at a company in terms of its ability to generate free cash flows. Now, free cash flows are understood in this context to mean the cash flows that are available to all capital providers. This means debt as well as equity. We're putting the debt and equity holders on one side of the balance sheet, on the liability side, and we're looking at free cash flows as being those cash flows which are being generated from the assets, operating the assets of the business. And therefore, given this approach, the free cash flows that we extract and model effectively into perpetuity, because a project is a company is like a project that has no terminal point to it, we will discount the free cash flow to capital at the company's weighted average cost of capital. That will be typically our discount rate applied to the cash flows. Now, practically speaking, when doing the cash flow analysis, we break up the cash flows in the future into what is called the forecast horizon. This would be specifically modeled cash flows. It's based on the past P&L, but it's extracting cash flows and it's looking into the immediate or near-term future, we could say up to 5 years, to understand what the revenue development and the gross margins and investment needs are going to be. So it's actually a very, it's basically a medium-term cash projection of the business, both operational and capital budgeting that's necessary. This is the, why do we say that this is a unique part of the modeling? It's because the modeling is done with the specific circumstances of the company in mind that we're determining the value of. We're looking at historical factors, meaning the recent past, to understand certain characteristics and structure of the financial statements of the company and its income statement, and we're driving those, we're projecting those forward over a period of time, usually up to 5 years. Now, when we get up to 5 years, to remain unique is more difficult, because it's difficult to model specific cash flows with costs and revenues in any detail after, say, 5 years. And certainly 10 years or 15 years, it would be completely impossible to do. The only thing we can really do is just say we make a simplifying continuing value assumption. And again, in valuation, everything turns on assumptions. Don't forget that. It's not a perfect science. In fact, it is a bit of an art. It's more a process. It's the line of argument one takes and the line of thinking in trying to come to some kind of opinion as to what the value of the company could be from different points of view. Now, once we have worked out the terminal or continuing value of the company, then we need to discount everything back to a present value, and we do this again typically at the weighted average cost of capital. And the result of discounting the free cash flows to capital by the WACC will give us what is called the enterprise or whole company, the company value of the whole company, with no distinction being made as to how much that company is financed by debt and financed by equity. So the enterprise value is kind of a gross value of the company if you want to look at it that way. Here we have a numerical example to show the forecast horizon, which is basically until year 5, and then the thinking behind what the continuing value of the business can be based on some kind of adjustment made to the cash flows, the free cash flows in year 5, to see what cash flow could represent the company for all future years. Doing the discounting, adding back the present value of the forecast and the terminal value numbers to arrive at the enterprise value. And finally, to achieve the equity value of the business, we simply need to deduct from the enterprise value the market value of the debt which is in the company. Now, this is DCF analysis can be done by a company of it applied to itself, or applied to the target companies that it may be seeking to acquire. If there is no acquisition of another company intended, but the management would like to somehow keep track of how much value is being created in their own company, then there are other methods that can be used. For example, the economic value added. This is a standard model which is used and has been covered in paper P4 for a long, long time. It's looking at the returns which are generated by the company in terms of cash-based profit generation as a function of the capital employed of the business. In other words, the company has so much capital employed resources available to it for generating a return, and the economic value added seeks to make adjustments to the basic financial statements to come up with a proper adjusted capital employed number. It's putting things that otherwise may be written off for various financial reporting rules, items that need to be added back or capitalized on the balance sheet. For example, capital leases, well, they are anyway, but let's say operating leases, if they're not on the balance sheet, they need to be placed there. If goodwill has been written off, then the AVA method calls for a number of adjustments to undo the results and the distorting effects of financial accounting. What AVA basically does, if we look at the AVA formula, and the attentive, the alert candidate will see the similarity here between the residual income, which is profit before interest and taxes, minus the capital employed times R. In other words, trying to determine what the opportunity cost of capital is, and to turn that into a monetary charge, and to charge it against the so-called net operating profit after tax, tells us whether AVA is being created. That is, if this is positive. If the net operating profit after tax, the adjusted income of a company as calculated by AVA, is less than the opportunity cost of its capital, meaning that this becomes negative, then the company is actually destroying value. So the residual income is also applying an imputed interest on its capital employed and deducting this from operating profit in order to determine whether or not the company is somehow making progress and able to generate returns above its cost of capital. And AVA, in a more sophisticated way, is looking to do the same thing. At this point, it would be recommendable to look for technical articles that pertain to paper P4 and specifically the AVA topic. Now, valuation type 2 adjustments, when we have a company in the same business risk, same industry, but the financial risk only is what's changing. Then the recommendation is to use the adjusted present value, which we have already mentioned in an earlier section of paper P4. So APV has a value in connection with type 2 acquisitions. Type 3 acquisitions, when we look at companies which are in completely different businesses and different financial risk, different business risk, then we have to see about adjusting our discount rate so that the discount rate accurately captures the riskiness of the cash flows, that we can achieve an accurate or reasonably good estimation of what the value is of the target company to be acquired. In order to round out our discussion of mergers and acquisitions, I want to stress that it's not simply a question of being able to do business valuation calculations, but to understand also from an institutional point of view the general principles regarding regulatory requirements when carrying out M&A. Here the City Code on Takeovers and Mergers is mentioned. That City Code is referring to London in the UK. And also, as senior managers, one is expected to take into account all factors, including possible objections from the Competition Commission if the resulting acquisition would constitute a restraint on competitive on a competitive market being able to operate. And the final step is the financing of acquisitions and mergers have to be carefully planned by the acquiring company, whether they're going to offer shares for the purpose or offer cash or some combination of the two. Share swaps are not uncommon, and therefore the CFO has to have a clear idea of what the implication is going to be on the resulting financial profile of the buying company according to the manner in which it pays for the acquisition. So pay close attention to these aspects as well. The key thing is to be able to ask the right questions as a CFO, and to obtain the necessary tax and fiscal and financial reporting advice for a particular transaction or a particular set of circumstances.